mira del pecho, no amarela que hice eso, deja de quemarme el chaleco, me pone la mira en el pecho y no sube esa mira del pecho, no amarela que hice eso, deja de quemarme el chaleco, eco, a Mandela, a Mandela, a Mandela, a Mandela.
Let's start with what happened during the case. The COVID-19 pandemic caused one of the fastest and most severe stock market crashes in history in early 2020. Starting in late February, global indices plunged as lockdowns, supply chain disruptions, and uncertainty over the virus spread shook investor confidence. The S&P 500, for example, peaked on February 19, but then fell 34% in just over a week, the quickest drop into a bear market ever recorded. Sectors were hit unevenly. Travel, hospitality, and energy suffered steep declines, while technology and healthcare showed resilience, even gaining due to remote work, medical demand, and digital services. Volatility spiked sharply, with the VIX reaching levels last seen during the 2008 crisis. Governments and central banks responded with stimulus package and interest rate cuts, helping restore some stability. By April 2020, market begins to rebound, supported by policy measures and optimism over vaccine development. The recovery was remarkably fast in some areas, where Nasdaq reached new highs by June, driven by companies like Amazon and Netflix, while the S&P 500 hit record levels again in August, making it the shortest US bear market in history at just 33 days. However, recovery was uneven globally. The UK's FTSE 100 lagged, remaining 15 to 20% below pre-crisis level by year-end, while Japan's Nikkei 225 bounced back strongly, ending 2020 about 16% higher. In short, the COVID-19 crash was unprecedented in speed and scale, but aggressive policy actions and sectoral resilience fueled one of the fastest market recoveries ever recorded.
So, during the COVID-19 pandemic, we saw two big financial risks, which are credit risk and liquidity risk. First, let's look at a credit risk. Many businesses could not pay their debt. For example, Virgin Australia went into voluntary administration and Hertz, the rental car company, filed for bankruptcy. When companies failed to pay, their credit rating dropped. This made it harder and more expensive for them to borrow money. Companies with weak balance sheet were hit the hardest. Second, there was liquidity risk. In March 2020, the SP 500 fell about 34% in just 1 month. Investors rushed to sell, but some sectors like airline and tourism became very illiquid. This means it was very hard to sell assets without losing a lot of value. The bond market, especially corporate debt, also faced huge pressure. To solve this, the central bank like the US Federal Reserve had to step in with emergency bond buying.
Okay, now we will add the two more points about the risk. Firstly, during the COVID-19 pandemic, the operational risk increased as lockdown forced the closure of factories, office and branch. This caused the production delay, disrupted cash flow and reduced the company revenue. Then, the slowdown in business activity also lowered the investor confidence and made the company shares less attractive and leading to the greater stock volatility. At the same time, companies had to adjust their standard operating procedures to comply with government restrictions. However, the remote working increased the exposure of cyber threats such as phishing, ransomware, and supply chain attacks. News of the cyber risk created the fear among investors and caused the further decline in stock price. Lastly is market risk. Market risk happen when interest rate, current value, and commodity price fluctuated. It is unpredictable and can cause volatility in the economy. The market risk can be divided into three categories, which is equity risk, currency risk, and also commodity risk. Firstly, the equity risk is happen when the stock market fell sharply as investors panic about the economic downturn. For example, Malaysia FBB KLCI have dropped by about 15% in 2020 as many investors sold the risky asset. Next, in currency risk, the Malaysian ringgit has declined against the US dollar in 2020 as the investor locked for safer currencies. This increased the import cost of business and create a financial strain and slowing down the market activity. Lastly is about the commodity risk, where the price of key commodities such as palm oil and rubber has fell because the global demand has dropped during the lockdown. So that's all for me. I will pass to the next presenter. Thank you.
The COVID-19 crisis showed us many lessons about investing. I will explain 4 key lessons that are most important for investors. The first lesson from the COVID-19 crash is the importance of diversification. Investors who focus too much on one sector like tourism and airlines lost heavily when travel stopped. Meanwhile, technology and online businesses grew. This showed that diversification helped reduce risk and protect investment. The second lesson is that the market and interest rate risks are very hard to predict. No one expected the pandemic, yet global stock market fell sharply. Even strong companies lost value. Central bank also cut interest rate quickly, which reduced bond return and pushed more money into stocks. This proves why investors need proper risk management through hedging, insurance, and diversified portfolio. The third lesson is the importance of long-term planning. Many investors panicked in March 2020 and sold their asset at very low price. When the market recovered, they missed out. On the other hand, patient investors who held on their investment managed to bounce back. This shows why discipline and long-term thinking are needed. The last lesson is that crisis can also create opportunity. During COVID-19, many strong company share become undervalued. So investors who took advantage of this were rewarded when the market recovered. So risk management is not just about avoiding losses, but also about finding opportunity.
Back in 2020, when COVID-19 hit, we all saw how quickly stock markets could crash and how some industries were hit much harder than others. It was a wake-up call for businesses about managing market and interest rate risk. The first big takeaway is diversification. When travel and airline stocks dropped, tech companies were actually thriving. Spreading investments and operations across different industries and locations can help balance out losses in weaker areas with gains in stronger ones. Another key tool is hedging. Using financial instruments like futures, options, or interest rate swaps can protect a company from sudden market swings or unexpected rate hikes. Think of an airline locking in fuel prices with futures contracts, or a company with variable rate loans switching to fixed payments to avoid rising interest costs. Having clear policies about which tool to use, acceptable risk levels, and timeframes keep decisions calm and strategic instead of rush. Liquidity is just as important. Keeping healthy cash buffers and having access to financing like revolving credit lines or overdraft facilities means a company doesn't have to panic sell assets or take on expensive emergency loans when revenue dips. Spreading out funding sources and testing different what-if scenarios ensures that those safety nets will hold up when needed. It also helps to regularly run stress tests and scenario planning for things like pandemic, sudden rate hikes, or geopolitical shocks. These exercises let managers spot weak points early, adjust their plans, and build a culture where teams are ready to respond quickly and confidently. And finally, none of this work without good governance. Active risk committees, open board discussion, and frequent policy reviews make sure strategies stay flexible and up to date. When boards and management keep the conversation open, companies can adapt faster. Combining good governance with diversification, hedging, and liquidity puts firms in a much stronger position to handle whatever the market throws at them next. So, that's all from us. Thank you.